Equity markets across Europe and US bounced yesterday, with big technology and software somehow leading the way, while Bitcoin lagged, missing the bullish wave of yesterday, unfortunately. Now, the rebound was supported by a mix of US economic data that was weak, but less weak than expected by analysts. Although the hawkish Fed minutes that came just after could dampen appetite at today's trading session. But even so, who cares? Fed is injecting cash right now to the markets to support the financial markets, and there is nothing more precious than that. So welcome to Swissquote's Daily Market Talk. It's Thursday, February 19th. I'm İpek Özkardeşkaya, and everything I will say in this episode is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
So equity indices across European and US markets were up yesterday. Even big technology and even software companies rebounded along with gold and silver. Bitcoin, on the other hand, was one of the weakest links in the market yesterday, as the bulls there missed the bullish wave of yesterday. Yet overall, it was quite a good and a construction session of trading. Now, yesterday's bullish breeze across the global financial markets was partly due to a set of weak but stronger than expected US data. The US durable goods orders, for example, fell, but they fell less than expected in December. Housing starts improved. The US industrial production grew faster and faster than expected, and all that added to the positive jobs report that was released last week, remember, showing that the US economy has added 130,000 jobs last month. So a stronger than expected set of data pushed the US 2-year yield higher from last October lows, but didn't necessarily weigh on risk appetite. On the headlines, Meta announced that it will be deploying millions of NVIDIA processors over the next years that will be worth tens of billions of US dollars for NVIDIA. So NVIDIA jumped more than 1.5% yesterday on the news, but remained offered near the $190 per share mark still. Even Amazon added 1.81% yesterday as investors shrugged off the news that Berkshire Hathaway dumped 75% of its Amazon holdings, scared that AI-assisted shopping would disrupt its e-commerce business. I mean, I think that Amazon has so much more to gain from AI than it has to lose, that I believe that Warren Buffett's last bet leading the fund may not be its best, but I don't know, obviously. I still think that Amazon has warehouses, it has logistics, has data center business, one of the biggest in the world, by the way, and it has chips that it is willing to sell to other companies. So when you're looking at Amazon and the ecosystem, it is still a very strong AI play, and the price has just fallen to the long-term bullish line. So to me, Amazon is good and appetizing at the current levels, but that's how markets work, right? Some people should be willing to sell for others to buy. Anyway, Round Hill's Magnificent 7 index rebounded yesterday as a result for a second straight session of its 200-day moving average. And looking at the trend and momentum indicators and considering the leveraged AI investment worries of the moment, the downside risk remain, but the selling pressure seems to be coming off. So sure thing that 2 consecutive sessions of gains gives some breathing room to investors today. Again, the big tech may be becoming appetizing now that the companies trade with a 10% discount to their record high levels, but there could still be better deals down the road if the sell-off continues. So the question is, will the sell-off continue, right? Well, the futures are slightly in the positive this morning at the time I'm talking here, but yesterday's Fed minutes will certainly not be a great help overall, as despite insults, firing threats, personal attacks, and public pressure from the White House and the US President himself, the latest FOMC minutes show that some Federal Reserve members still wanted to add a statement saying if inflation in the US remains at above target levels, and that's about 2%, and we are steadily above that 2% level since the pandemic months, well, the Fed could raise the interest rates. Now, that would obviously spook the White House that wants these interest rates down, and that could also mean higher tensions inside the Fed and for the Fed's trajectory when Jerome Powell will be replaced by Mr. Kevin Warsh, who more likely than not gave sort of a promised to the White House that he would be pushing for lower interest rates come hell or high water. But it would still be great if the Fed's direction is justified by economic data, because otherwise the policy transmission may not go smoothly, and that's not a good thing. If the Fed cuts rates and investors think that it shouldn't, the yields wouldn't follow the rates lower, leading to poor or opposite impact on borrowing costs and mortgage rates that have a real impact on the economy. So whoever sits at the Fed, the data will be important. So today, Philly Fed Manufacturing Index will be closely watched by investors. And tomorrow, the latest US GDP update and the core PCE index will be among the most important data points that will add dots to be connected on the macroeconomic picture. The US GDP growth is expected to have slowed to 2.8% in the fourth quarter from 4.4% printed a quarter earlier, reflecting a potential return toward trend as big one-off AI investment surges fade, net exports turn into a drag amid trade disruptions, and consumer and housing spending in the US moderates in the face of higher borrowing costs and higher uncertainty. The core PCE index, on the other hand, which is the Fed's favorite gauge of inflation, may have rebounded to 3% in December, above that 2% policy target. And the combination of slower growth and persistent price pressures is a central bank's worst nightmare, as it's a double-edged sword. If you ease monetary policy to fuel growth, well, inflation will flare up, and you don't want that to happen when inflation is already above target. And if you tighten the monetary policy to tame inflation, well, growth slows more. Add to that a White House that gets involved in every single decision that's made in the Fed to prioritize political matters. Well, I'm sure that Jerome Powell will be more than happy to say goodbye in May and leave the mess to someone else. But anyway, the good news is that whoever sits at the Fed and wherever the rates go, the liquidity injection never fails. If you are looking to explain the past 2 days' rebound in the global financial markets, I would suggest that the most reliable cause and effect relationship is the amount of repo purchases. They spiked on February 17, tells the latest Fed data, and it coincides with the overall market rebound. How magic! It's still fun to look at the economic data and try to make parallels and sense of what's going on, otherwise it would be just too easy and a bit boring too. Now, in the FX markets, the US dollar is better a bit since yesterday, say on strong set of US data. The euro dollar is sharply down, consolidating losses a touch below the 118 mark and a few pips above the 50-day moving average that stands at 1.1770 level. Cable slips below its own 50-day moving average and below a major Fibonacci support as well, which is the 38.2% Fibonacci retracement on November to January rebound, suggesting that the pair has now stepped into the bearish consolidation zone and has room to extend losses further, and the latter matches perfectly the rising dovish Bank of England expectations this week after a set of data earlier this week pointed at weakening jobs market in the United Kingdom and softening inflation. And it feels so satisfactory when the fundamentals explain the price action this well. And finally, crude oil rebounded yesterday as peace talks between Russia and Ukraine ended abruptly, and Iran and US talks didn't rule out the possibility of a broader military operation in the region, implying US and Israel. Now, it's extremely hard to tell what's next, but if the Middle East tensions ease on fruitful nuclear talks between the US and Iran, for example, well, crude oil could be good to sell at the current levels. If, however, threat of a war rises, a scenario that would grandly shake the Middle East in the medium run, then we could see the actual price spike in oil turn into a persistent medium-term positive trend. And if that's the case, we could reasonably see US crude go all the way up to the $80 per barrel level. I hope it will not. So this is all for this week because I will be off just tomorrow. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend in advance.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.